On Tuesday, all three metals, silver, platinum, and gold, showed signs of weakness. But here's the catch. Silver hinted at it early, platinum a bit later, and gold only during regular trading hours. By comparing them, you could have predicted gold's sell-off in advance, all using simple DR basics. Let's break it down. We will start with silver, and there's a reason to that. Silver started its week with a DR upside model on Monday with a great trade opportunity in the overnight session. If you analyze the retracement after the confirmation with all the basics that I teach, you should find a lot of gems. But we are focusing on the Tuesday price action. Zooming in, Tuesday's aftermarket and overnight session has already formed. What information do you already have? The DR intraday cycle started with the aftermarket session being inside the previous day's regular session, also what I always refer to as the DR range contraction model. Ideally, you'd expect the previous day's RDR highs and lows to be very sensitive and price gets squeezed into one direction first, before making its real explosive move to the other side. Here in silver, the aftermarket session took out the previous day's regular DR highs. Sure, there's always a possibility that the overall session highs can be taken as well, but you don't want to bet on that probability. Rather focus on the DR and IDR highs. So we already know that price got most likely squeezed into one direction early on. The overnight DR session then opened and closed as a green DR box, with the closing price being higher than the opening price. This increases the probability of seeing a long confirmation, but with a roughly 70% of doing so, it's not guaranteed. Price has other plans. It confirms to the short for the session. But why is that actually good for you as a trader? Because the squeeze to the upside in a DR range contraction model has most likely happened early on in the ADR and the previous day's RDR lows haven't been targeted yet. This gives you already a possible target for the session that also aligns with the one standard deviation level. Now, if you add the DR basics to that to plan a trade and execution, you have previous DR levels, the aftermarket and previous day's RDR mid-levels, and intraday gap imbalances, especially those from the aftermarket session, that align with the current session. Half an hour after the short confirmation, price starts to show clear rejections from the aftermarket lows for a potential entry with stops above the mid-levels, but offers less than 3R, and the only way to catch it would be by a limit order. Unfortunately, this trade would result in a loss, but price retraces now into the retirement setup area with multiple confluences as well. The aftermarket session highs and also several gap imbalances which are being rejected support a perfect trade setup here. While a trade with stops above the range doesn't really work here, you can wait for clearer signs like a close below the gap imbalance area, and then trade a more aggressive approach with stops above this area for a potential 3.4R trade. Price drops lower, reaches the target, and later in the RDR it drops even lower, forming a nice range expansion model. Look where it came back into within the first hour. All these levels outlined earlier seem to be very important to price, don't they? So the biggest lesson in Silver's Tuesday was the early squeeze in the aftermarket session, before the explosive move happened to the other direction. Now let's have a look at platinum futures, another metal with similar price action behavior. It also started the DR intraday cycle inside the previous day's RDR, confirmed long but didn't finish the squeeze into either direction. Ideally, you'd wanted to see price get squeezed into the previous day's RDR highs for a potential target, but that didn't happen like it did in silver. So price is still trading inside the previous day's RDR range and the overnight session has formed while also confirming shorts. Careful. The aftermarket session confirmed long while not finishing the squeeze, but when extending the aftermarket session mid-level, you can also see that price has a hard time to close below it. A rather weak confirmation and the ADR mid is acting like a barrier. Remember what silver did. It squeezed to the upside before an explosive move to the downside. While price trades higher, it doesn't really give clear rejections for a trade except maybe a potential retirement setup. This retirement setup would result in a loss, but the overnight session reveals something else. The previous day's RDR highs and also the session highs were taken. With that, the squeeze in a DR range contraction has most likely played out, and price eventually will trade into the other direction explosively. Price trades aggressively lower, the regular DR forms as a red box and also confirms shorts. While doing so, a perfect DR range expansion model is also forming, which gives you already a great potential target for the session. Looking to the left, there are several previous DR session levels aligning from earlier week. 20 minutes of absolute rejections give enough time to find an entry with stops above the lower area of previous DR levels, and there you go. 3R trade with pure logic that has been followed. The takeaway? While silver gave early signs for a sell-off in the aftermarket session, platinum did so in the overnight session. This was like unfinished business before the actual move. And lastly, we will have a look at gold futures on the exact same day. What do you notice? Gold didn't start its intraday cycle inside the previous day's RDR, excluding a DR range contraction model. The aftermarket session found support at the previous day's RDR mid, confirmed long and traded higher off a rejection from the previous day's RDR highs. The overnight session then opened and found support at the aftermarket highs before confirming long and trading higher up until the regular DR session opened. A clear DR upside model structure has formed with an DR upside model being intact. While gold trades higher and follows an upside structure up until the regular trading hours, silver already signaled weakness in the aftermarket session and platinum a bit later in the overnight session. Overall, both silver and platinum traded lower in the regular trading hours after a squeeze has happened out of a DR range contraction model. Then the turning point in gold. The regular DR session opens, trades a bit higher before it closes as a red DR box and a short confirmation. The candle not only gives you a high probability for shorts during the session, but also another valuable information. It violates the overnight session lows, and therefore you can already exclude a DR downside and upside model, and also a DR range expansion model, since the ADR is bigger than the ODR. This constellation right here has been covered multiple times now, and it's a great reminder to study all previous breakdowns as well. What would be a low-hanging fruit target for the session here? The ADR lows. They also align with the one standard deviation level. Add all relevant DR basics, such as previous DR levels, which in this case are only the ODR high. You can also add the overnight sessions mid, since it aligns, and don't forget to have volume and gap imbalances ready when needed. 5 candles show clean rejections from the ODR mid and the IDR low of the current session, and you'd have like 25 minutes to plan and execute a trade here. A quick look at volume imbalances also supports this idea. Other metals like silver and platinum gave early signs for potential weakness, and as soon as gold broke the upside model with the short confirmation, multiple signs were there to trade into the short direction and follow the weakness. That's it for today's breakdown, guys. I'm sure there was indeed a great lesson. Leave a like and comment. Don't forget to subscribe to the channel and visit m7dr.com if you are serious about taking your trading to the next level. Have a good trading week, and I hope to see you in the next video.
We're gonna take on the world.